It's a beautiful new Monday morning, and you're listening to Smooth 98.1 Love Music, Love Life, 32 minutes past 6 a.m. Yours truly, Ayokunmi, ready to walk you into another week, the final week in the month of July 2025, 2025. And looking forward to what the week has in store for us, all the amazing things, and of course, everything coming together to make up what it is that we are after, what we're chasing, what it is we get up so early in the morning to get out there and get done. But anyways, it's that time on the Smooth Breakfast where we get to talk about business. This is Business Express brought to you by InterSwitch. And this morning, it's going to be an interesting conversation because we have a new report from Vetiva Capital Management on Nigeria's banking sector with outlook on the second half of the year. And joining me to take a look at said report and just give us some insight into what exactly is going on is Oluwayemisi Sunmola. He is a banking research analyst with Vetiva Capital Management. Very good morning to you, Oluwayemisi. Great to have you on the show.
Thank you very much for having me, Ayokunmi.
Very, very good to have you to talk about this particular report. Interesting things coming out of it. We'll try to dive in to just take a look at some of the issues here, and you can break it down for us. So let's start with an important profit metric for banks, which is net interest income. For my benefit and for the benefit of everyone who is listening out there, can you give us a definition of what that is?
The net interest of the bank is largely what constitutes the core bank earnings, which is the difference between the interest these banks earns on loans and investments from
Mhm.
what they actually pay on deposits to customers, which is their interest expense. So it's kind of like their net earnings from their core banking operations.
Okay, that's a very simplified definition. The kind that actually like just goes straight to what exactly it means, taking away all the technical jargon, which I tend to run from. And so you listen out there, you can join the conversation on YouTube. You can leave your comments there at Smooth 981 FM Lagos. Smooth 981 FM Lagos. Please leave your comments in the chat box right there. Okay, let's continue here. Now, uh your report notes that there was an average net interest income increase in the first half of 2025 of 54% for the banks. What exactly drove that?
Yeah, so the major driver behind the heightened net interest income we saw across the banks was largely as a result of the elevated rate environment we saw in H1 2025, which also fed from the high rate um, environment of 2024. So we saw the central bank hold keep monetary policy rates very elevated around 27.5. So a lot of the banks actually benefited from higher yields on loans as well as government securities. Um, and since the repricing of these maturing assets, it improved the lending capacity of the banks and caused the significant uptick in their net interest income.
Okay, it's actually interesting that you reference the interest rates being high. I think at the tail end of 2024 into the first half of 2025. But for the second half of this year, you're forecasting an average net interest income growth of 20%. Bearing in mind that, I mean, as at the last MPC meeting, the rates were held. They weren't taken up or reduced. So still kind of at a high level, kind of. So why the slowdown in the forecast for the second half of the year?
So in terms of expectations, we expect that because in terms of the actual cost of these funds on the government, we expect that the government would slow down on the interest rates. Already, we are seeing in the secondary markets, yields on a lot of fixed income instruments are currently moderating, and we expect that to only continue and fade out through the rest of the year of 2025. And as a result of that, we expect that we would actually see the income across the banks moderate till they um, reach a state of some sort of stability, hence the
Okay.
moderation in terms in our projections.
Mm. Okay, so from all indications, it seems like there seems to be a level of stability within that sector compared to the ups and the downs, which made things a bit difficult to actually pinpoint. But it's good to see that there's a level of stability that is coming into play here. Okay, let's talk about the loan books of the banks. Now, you are forecasting 19% year-on-year growth in gross loans. But your report says the banks are applying caution. I mean, why exactly would that be?
Yeah, so we project that loan growth forecast would be around 19% for 2025. So we also expect that the banks would be cautious. We expect that the banks will prioritize high quality short tenure exposures in key sectors like energy, telecoms, as well as exports aligned industries. And as a result of the current ongoing macroeconomic uncertainties, as well as some sort of elevated credit risk in the corporate segment, we expect that the banks would slow down on their exposures on loans, um, and as well as focus a lot on the attractive yields currently in government securities, which offer a better risk-free alternative.
All right. Interesting perspective there. Now, I want to point out something that actually caught my eye and is kind of interesting in the reports. Now, it shows that the loan books of Access Core, First Holdco, UBA, and Zenith are larger than the other tier one banks. What could have caused that? Why is that? That caught my eye and I had to bring this up.
Okay. This stems from one, their scale, as well as the amount of diversified operations. We've seen a lot of these banks have significant exposure to a lot of sectors like oil and gas, infrastructure, and manufacturing. So these banks basically have some sort of broader footprint and as well as stronger
Mm.
capital bases, which will enable them to underwrite larger transactions and absorb more credit risk naturally.
Okay, so that's okay. So that basically is it. So it means that the other tier one banks who are probably
Yeah.
not, up to this level, they're not necessarily in any trouble, any problems, as it were, right?
No, no, they are not. It's just
Okay,
based off their size and their capital base,
okay.
which, yes.
All right. So still talking about the loans, let's talk about the forbearance impact. First, can you explain regulatory forbearance and loan impairments for the benefit of everyone?
Okay. So this regulatory forbearance was a temporary relief measure the CBN gave the banks, which had significant exposures to some credit risk from the COVID-19 pandemic, where a lot of businesses actually could not service a lot of their loans. So basically, what the CBN allows these banks to do was to restructure their loan book and
Mm,
classify a lot of these loans under lower risk categories. Um, because if they didn't do that, this would have caused a significant spike in their impairment charges, which is their loan, the amount of money that these banks basically make room for in
mhm.
terms of bad loans. So basically the CBN didn't allow them classify these loans as bad and let them classify them under lower risk categories in order to avoid higher impairment charges. But now what the CBN is saying is actually exit this your position so we know the true standing of your financials.
Okay, so you mentioned that the regulatory forbearance is a temporary measure. I mean, how temporary is temporary?
So what the CBN now is saying is exit your if you do not exit your forbearance, if you do not exit your forbearance exposures, right, do not pay dividends, kind of like some sort of motivation to the banks to actually get rid of their forbearance exposures. So until the banks are able to exit their forbearance exposures, they won't be able to pay dividends. So there wasn't really some sort of timeline to it, but it's actually in the best interest of the banks to actually exit this position. And we've also been seeing a lot of these banks actually try make some moves, with most of them saying that a lot of their forbearance exposures will be exited in the first half of 2025, and they
Okay.
would maintain dividend payments.
Right, right, right. Okay, thank you for clearing that one up. Now, I see that you are forecasting an 86% rise in loan impairments in 2025. I suppose you're trying to tie that to the regulatory forbearance, correct?
Yes, yes. So we expect that as the banks exit their forbearance exposure, they would front load their impairment, hence the spike in their impairment charges. Um, in the short run, it could some sort affect their PAT, hence a slight modest uptick of 10% to expect in their PAT levels for the year 2025.
All right, all right. Thank you so much for that one, Oluwayemisi. Now, before I let you go on the show, as we begin to wrap things up. I beg your pardon, not off. No, looking at the state of banks in Nigeria at the moment, with one eye on the recapitalization policy of the CBN. I think that was announced last year. There's a deadline of 2026, if my memory serves me correctly, and we're in 2025 right now. Now, from your perspective and from everything you've seen and all the information you have overall, would you say that Nigerian banks are going to remain healthy?
Yes, we expect that these banks, hence the recapitalization, we expect that this will bolster up the capital levels of the banks and would make them stronger in order to be able to absorb a lot of the macroeconomic headwinds and actually stay resilient. So we are quite very optimistic about the banks in both in the short, medium, and long term.
All right. Fingers crossed on that one. Thank you so much for all the insight. We've been talking about Vetiva's Nigeria banking sector second half of 2025 outlook. And I've been discussing this with Oluwayemisi Sunmola. He's a banking research analyst with Vetiva Capital Management. Thank you so much, Oluwayemisi, for joining me this morning.
Thank you very much for having me.
All right. Do you have yourself a great Monday, great rest of the week as well?
Thank you very much.
All right, then. Cheers. Thank you all so much for being a part of the show this morning. Business Express brought to you by Into Switch. Thank you once again. All right, the show kicks on. A lot more to come this Monday morning, getting you into the groove to start your week on the best possible note. You by Into Switch. All right.